This is the current federal tax developments for the week of June the 9th, 2025. Current federal tax developments are brought to you by your state society of CPAs, and we're going to talk this week about some things that went on during this week here in tax. I was on the road this week, so I was out in Atlantic City, New Jersey, talking at the New Jersey Society of CPAs convention. We talked about a couple things where we stand with the replacement for TCJA, or what's now the One Big Beautiful Bill Act, and also discussed a little bit about the self-employment tax fund. So have a little deal with that we did. But this week, we're going ahead and going back into just the standard updates. We're going to first discuss an IRS release that gives us some simplifications on the corporate alternative minimum tax if you're one of those who has to deal with that little thing here. We also have a conservation easement case, valuation, penalties, and problems. We're discussing these some because a lot of them keep coming up in the courts. We have a collection due process and offers and compromise case to work with here. That one's kind of interesting. Also, some accuracy-related penalty questions. And the real question is, what exactly is sufficient reliance on professional advice to get you out of an accuracy-related penalty? And as you may discover in this case, we're going to discover a taxpayer who simply didn't have sufficient professional advice or hadn't properly relied upon it. We are going to discuss the Treasury request for information on how they should communicate going away from paper payments, either receiving them or making them. So I know there's been a lot of discussion among many people about how that's going to affect taxes. We'll get to what they're asking for, at least. I'm going to talk about an interesting case from the Ninth Circuit. If one taxpayer ends up with a discharge of indebtedness, does the other taxpayer automatically have a bad debt? And we'll discover that, especially when the two taxpayers are related, that answer could very well be no. That's a case we'll discuss here with the Ninth Circuit deciding to back up the tax court and say, yeah, we don't buy it in this case. We're not going to accept it. And finally, we'll talk about a Supreme Court decision here, looking at the religious exemption landscape and what is going to be essentially, we look at unemployment taxes. And this is kind of a federal issue, even though it was a Wisconsin state law and a Wisconsin decision, because the language is based very much on similar language found in the federal law for the Federal Unemployment Tax Act. So we'll discuss that as well. Let's talk about the corporate AMT, IRS Release Notice 2025-27 on June the 2nd. So basically, the notice provides some interim guidance for you dealing with your corporate alternative minimum tax and offers some significant estimated tax relief for those who are involved with that. It's basically, if you have clients who are involved in, have to pay the corporate AMT and need to comply with it, we'll talk about some definitions, some simplifications. If you have a client who doesn't need to comply with it, but still needs to demonstrate they don't need to comply, and we'll talk about some simplifications there and that background. Now, if you remember the corporate AMT, it was enacted by the current version, the Inflation Reduction Act of 2022. It's, again, under Code Section 55. We've had many changes to this over the years. The corporate AMT has gone from something that applied to all C corporations to something that is applied mainly to large C corporations, then applied to nobody, and then applied to only very large C corps. So that's kind of where we're at here. So the 10-year minimum tax, if you're subject to this, is 15% of adjusted financial statement income, AFSI, for the taxable year, less the corporate AMT foreign tax credit that you can get. Now, if you're an Apple corporation where you're going to be covered by this, you have to be not an S corporation, not a registered investment company, mutual fund, or REIT. It has to satisfy either of two average AFSI tests for one or more prior taxable years, ending after December 31st, 2021. So we set it with basically a gross income style test for the most part, right? Generally, your average annual AFSI for the 3 taxable years ending with such taxable year exceeded $1 billion. For a non-foreign entity, or for a foreign entity, their AFSI test is for this foreign parented, get that out right, multinational group member. Both the general AFTI test and average annual AFSI is $100 million or more. And generally, net income or loss reported on taxpayer's Apple financial statement, subject to various modifications. That's AFSI. So it's based on this concept that we've seen now a number of times in the tax law, both in regulations and now inside the code itself, of this thing called an Apple financial statement. And it's basically the same where we always have had. So we're looking for that background, if you've got it. What's it going to be? Now, before this notice, the Treasury and IRS issued several notices. You had Notice 2023-7, Notice 2023-20, 2023-64, and 2024-10. There were proposed regulations issued last September on the 13th. They addressed the corporate alternative minimum tax, including a proposed simplified method of determining applicable corporation status. The problem is, the work of actually computing this tax is not really that difficult. Yeah, it's 15% of a simplified calculation. Well, not really simple, but still. The mess is figuring out if you are an Apple corporation with the add back, subtract, etc. If you've got that done, you got a pretty good head up on actually getting this thing computed. So our question is, do we need to do it? And that could be a very, very messy computation. Now, in the proposed regs, there was a simplified method that applied if you did under simplified test, you met a $500 million threshold, or for the general test, or $50 million for the foreign parent groups test. Then essentially, if you met that test, then we don't require you to do the full-blown calculation to prove you don't meet the test. The theory being that there was enough spread there from 500 million to $1 billion that it wasn't likely. We had 50%. That it wasn't likely that we're going to discover that really, if we did the full computation, we would end up very, very likely to be a covered corporation. But we still have to do that computation. Now, a lot of comments said, well, that's a good idea. We like not having to do the full computation for every C Corp. But we think the threshold should be raised. That'll help reduce the compliance burdens and include AFSI adjustments for certain tax credits in the simplified method calculation. So including a few more things to help us theoretically get it down, right? So the company wouldn't have to go there. Now, there is a new optional interim simplified method for Apple Corporation status. And this was provided in response to this complaint we need to reduce compliance burdens. It can be used for any taxable year ending on or before the date final regulations adopting a simplified method are published, provided the original federal income tax return for that year has not been filed. And the modified threshold is going to be, we're going to raise it to 800 million and 80 million from the 500 million and the 50 million that we had here. Okay. So basically, we're going to jump the number up quite a bit. So that'll get people in. Now, again, that's really our threshold for revenue. So if you come in below 800 million under the simplified test and you're not a foreign entity or foreign group, then basically we're going to consider you fine, right? We're not going to worry and force you to do the full-blown calculation to prove you're below $1 billion. Now, this includes adjustments for certain related party transactions, covered taxes, federal and foreign income taxes, certain tax credits, and has been modified, and tax-exempt entities. Now, the key difference is AFSI is determined without regard to any other adjustments that are set forth in Section 56A, C, and D. Now, the big caveat is if a corporation uses this method and determines its AFSI exceeds the modified thresholds, it is an Apple corporation only if it is also determined to be one under the statutory standard test. So basically, if you pass this test, then we know no, you're not. If you come in below the numbers, you're fine. If you come in above the numbers, you may still not have to you may still have the AMT apply to you, but now you got to go through the full-blown calculation to show for sure if you stayed below the $1 billion or $100 million threshold. There's also a waiver for the AMT estimated taxes. So there is a waiver for the addition to tax for underpaying your estimates, specifically with regard to a corporation's corporate AMT liability under Section 55. The period involved is any taxable year that begins after December 31st, 2024 and before January 1st of 26. This is called, in the ruling, a covered CAMT year. And for a covered CAMT year, corporations' required estimated tax installments do not need to include amounts attributable to its AMT liability to avoid the underpayment of estimated taxes. That's a temporary level of relief. Now, this waiver does not relieve a corporation from its obligation to pay this liability, when it's due. So, if you just screw up and don't notice that you should have paid an AMT tax in your C Corp return, yeah, you're still going to be subject to the failure to pay penalties, right? And all of those structures are still there. So all it does is gets rid of it from the estimates, right? Now, if you claim this relief, you have to file a Form 2220. This is not automatically granted. Underpayment of estimated tax by the corporation with your return, it must be completed without including the CAMT liability from Schedule J of Form 1120. And you must report an amount of estimated tax penalty on line 34 of 1120, even if that amount is zero. So basically, we need a computation with 2220. We need to carry that result forward to the return, even if we're not going to, we get fully out of it by having this done. We don't have an estimated tax liability. You got to flag it. You got to have the computation attached. Obviously, this notice offers some clarity and some relief in getting this done, especially on the simplified calculation. The fact we've raised the level at which you can rely upon that. The optional interim simplified method potentially reduces compliance burdens. It's especially if you're near the statutory threshold because we've got it down. Previously at 500 million, you just had to be way below the statutory thresholds in order to, be able to use it. Now at 800 million, it's more likely to get people that are much closer to it. And obviously, if you're above, if this won't compute out to below 800 million, then you really got to go through the full computation. That's basically how it goes. And the estimated tax penalty relief for the corporate alternative minimum tax estimated tax payments for years beginning 2025 provides time as taxpayers and practitioners navigate this whole new law regime. It's what's there. Remember, we are expecting future guidance, so we expect to issue additional interim guidance on various corporate AMT issues based on comments received. It's also anticipated that new proposed regulations revising the current proposed regs that are out there will incorporate rules similar to the interim simplified method dictated here. So the expectation is that these higher levels will become permanent. And for practitioners, you need to pay careful adherence to the instructions for claiming estimated tax relief. Remember, even though you qualify for it, you got to fill in the 2220. Don't just go, hey, it's clear. Regular tax, if we didn't pay the AMT, we'd be fine. It's not going to be automated. The IRS is going to notice that and waive the penalty. You're going to have to actually attach the 2220 and make this claim. So be aware of that. So follow the instructions carefully to make sure you don't get a bunch of correspondence over this issue if you're covered by it. Okay, let's talk about conservation easements, valuations, and penalties. This is a warning from the tax court in Beaver Dam, I'll get this right, Creek Holdings, LLC versus Commissioner. This is a tax court memorandum decision, 2025-53, and it was issued on June the 2nd. Now, in this case, the U.S. tax court scrutinized the valuation of a conservation easement donation. It resulted in a disallowed deduction and imposition of the gross valuation misstatement penalty. Remember, that is a misstatement penalty for which you cannot get out of it under a reasonable cause basis. So we've discussed that before. This is a problematical penalty, right? The case was a reminder of the need for robust market-based valuation for conservation easements and highlights the consequences of overstating those benefits. And as with a lot of these cases, the overstatement's not going to be small. Right, we're going to have an overstatement that the tax court at least is going to hold was very significant. Now, a taxpayer in this case was Beaver Dam Creek Holdings LLC, partnership based in Georgia. The property in question were 85 acres in the Alberton Granite area, with a history of granite quarrying operations that ceased in 2008. Now, Beaver Dam acquired this property essentially 9 years after those operations had ceased. A related transaction in December 2017 effectively valued 100% of the property at approximately $225,052. On December 28, 2017, Beaver Dam conveyed a conservation easement to Foothill Land Conservatory to preserve the property as a watershed and open space, prohibiting commercial, industrial use, and further mining. Now, of course, we all know that for conservation easement, though, since, normally if you only give a partial interest in a piece of property, you don't get a charitable contribution. The conservation easement rules allow us to get basically a charitable contribution deduction for this partial interest we get, this essentially easement that we've granted to the charity. But it's going to be based on the value of that easement, which generally is going to be the difference between the value of the property if that easement was not in place and the value of the property with the easement in place. And as you might guess, we tend to fight a little over what that is. In this case, they claimed that the value of the charitable contribution was $21,972,000 on their price return. Now remember, this was, basically a piece of property that we found through similar transactions, that similar properties were like going for well below $300,000, and we're claiming nearly $22 million as a charitable contribution. That somehow the easement was worth $22 million, even though you could essentially buy equivalent property for well under $300,000. Well, what that is, it's the same thing we've talked about before. This appraisal by VSW dated March 1st, 2018, used again the before and after methodology. And the before value, okay, so far so good, that's fine, was based on a discounted cash flow analysis for granite extraction. Remember, granite extraction had not been taking place in this property for 9 years and was not currently taking place in this property, right? Now, and we remember that sounds familiar because we've gone down this road before. It wasn't granite extraction, but, basically the same sort of problem where we have a theoretical business. Theoretically, we're going to say that we could, operate a business there that would be wildly profitable. But we're giving this, which, by the way, by itself sounds a little suspicious. If I've really got a business here that could generate, could make this land worth nearly $22 million, am I really going to make that charitable contribution? Or would the smart move for the investors be to actually operate the dang thing? Or at least find a buyer who wanted to operate it so that you could actually get $22 million out for this amazing fine. Again, the IRS disallowed the entire deduction, and they proposed the 40% gross valuation misstatement penalty under 6662H. Now, burden of proof, as always, is generally on the taxpayer, the petitioner in this case. The taxpayer must come forward with evidence to support their entitlement to deduction and the amount of that entitlement. Now, a qualified appraisal under the law is required to be attached for a non-cash contribution exceeding $500,000. It must be conducted by a qualified appraiser in accordance with generally accepted appraisal standards, right? USPAP. An appraiser is disqualified under these rules if the donor knew facts causing a reasonable person to expect them to falsely overstate the value. As you might guess, the IRS is going to claim that, hey, wait a minute. These guys knew. They signed up somebody they knew would come in at $22 million. That's how they chose their appraiser. So that's going to be the IRS's theory of the case. Now, the fair market value is pretty standard fair market value discussion. For these purposes, the price at which the property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell, and both having reasonable knowledge of all relevant facts. So that's our idea, right? It's not a particular buyer, or even this particular seller. We're looking at this generic idea of a fully informed buyer, fully informed seller. What would the fair market value of the property, both before and after, be? Now, before and after method is used where there is no substantial record of comparable easement sales exists. Fair market value before restriction minus fair market value after restrictions. That's going to normally be what you have to do because rarely are you going to find comparable property with the same, with exactly the same easement in place. And then comparable property doesn't have easements, right? So, we need kind of both sides. Now, the highest and best use is reasonably probable and legal use as is physically possible, appropriately supported, and financially feasible, resulting in the highest value. Now, if your proposed highest and best use is too risky for a hypothetical willing buyer, it is not HBU. This is somewhat important. Remember, this thing has been sitting there for 9 years. And if it really was this undiscovered diamond in the rough, it seems odd that 9 years nobody noticed that. Because it had been operated as a quarry. If this thing really could operate as a super quarry, why hadn't anybody noticed it? Why had anybody in the business noticed it? Would be one of your key questions you have to ask yourself. Well, the real property valuation approaches out there are market, comparable sale, income, discounted cash flow method, and cost. Now, a comparable sale is generally the best evidence of market value, especially for land, including actual arm's length sale of the subject property itself. The income approach, DCF, is not appropriate for valuing the land itself. And this is what's tripped them up in the prior case too. The tax court is holding this consistently. You cannot value the land itself under DCF. The land is valued on comparable sales. What are real people paying for comparable land? That's what makes a lot of these easement programs rather difficult to buy, in terms of just on their, something smells fishy here. I mean, why in the world did you get this super discounted price? Because what you're telling me is nobody's noticed the inherent value of this property. Either that, or you just stumbled on the greatest, one of the greatest coincidences in the world that you bought it. You didn't know, nobody knew all the great value here. And then suddenly in the year before in the year you wanted to hold this thing before you got long-term capital gain status, in that year, suddenly it became clear of this great value, which is really tough to say that was the reason. If you were selling this, selling this, deal, packaging this up deal with full plans to do this conservation easement donation as soon as you got the property, when you first had a chance to get the property. Yeah, it's a little tough to follow along with. Now, they said the burden of proof remained with the BC investors for the deduction amount, as their evidence, the discounted cash flow analysis, did not credibly support the $21.9 million deduction. They never showed us why you'd pay nearly $22 million, I guess, plus $200,000, $300,000, over $22 million, for this land. Why would a buyer pay that much for land? Now, they did say that their appraiser was a qualified appraiser. The court found the appraisal did not fully comply with the USPAP standards, but it was not so deficient as to fall, basically fail entirely to be the generally accepted standards, nor was there any evidence of intent to falsely overstate the value. They did not set out to do that. There was really here the legal question, at court of whether this DCF method they were going to use for a theoretical granite mine was a valid way of doing this, right? The court agreed that the highest and best use before donation was to operate a quarry, given its history and lack of other uses. However, that still didn't validate the income method evaluation. Again, the court rejected their experts' discounted cash flow analysis, finding that they valued a hypothetical speculative business rather than the property itself. That value only occurred after you made major league investments, in theory, and operate this business and didn't fall afoul of any problems that aren't known. Because again, why didn't they just do this themselves? Is the obvious question any realistic person would ask themselves. Realistically, if that was you and you had a piece of land, unless you are insanely charitably inclined, and even then, you're probably better off that charitably inclined, to just sell the property, get the cash, or donate the whole property itself and let the charity sell the property for that $22 million. They probably could do a whole lot more with that. Even if they are in the preservation business, there's probably a lot more they could do than, they're just going to have this one piece of land, and that's the only thing you're going to save by doing this. So, yeah. Now, the court's valuation relied primarily on comparable sales and the actual sale of the property itself. It assigned significant weight, to SGC's effective sale of the easement property for $225,052 in 2017 as a ballpark before value. It considered comparable sales data of the Granite City Quarry sold for $300,000 in 2016, and the court determined the before value was $300,000. The after value, if these restrictions are in place and you're just trying to sell this property into the market generally, you'd say, well, you would get $106,700 with this restriction in place. So the easement value would be $193,250. Subtract those two numbers, that's what you get. Right? The problem is that was a bit below the $21,972,000 that was what they were claiming. That means because there was a gross violation under 6662H, this is a gross valuation misstatement. We are not anywhere close to the right number. That triggers automatically 40% accuracy related penalty. The tax benefit the taxpayers received from, claiming this deduction will be hit with a 40% penalty. Right? So for all the years they took it, because probably more than a few did carryovers into later years, we're going to have that issue. And remind yourself, the Pension Protection Act of 2006 eliminated the reasonable cause exception for gross valuation misstatements of charitable contribution property. So it doesn't matter if they thought that this was a really good appraisal guy, knew what they were doing. They actually had legal advice stating that the DCF method was valid for valuing the land itself and not just for a before or after computation, where they would say, where it would help you determine maybe what the value of the land is after, with this restriction in place. You can't use that here. Reasonable reliance on there. Now, remember, we talked a couple weeks ago about a case where in their case, the foul up was that they hadn't really had a qualified appraisal, but they thought they did. That you can still make work. Now, again, in that case involving, the paintings, or a painting really was what it was about. They still couldn't go gross for that valuation. The fact the number was way off, they couldn't save that. They could save, though, the actual, qualified appraisal. So, hey, which meant that, it really didn't help that much in that case, but it did help some. In this case, they won the fact it was a qualified appraisal, but the number was just so wildly off from what was allowed that 40% penalty was going to come into play. So, some key takeaways. While the highest and best use may support mineral extractions, the valuation must reflect what a willing buyer would pay for the property itself, not the speculative net present value of a hypothetical business that would go on that land. Okay. Tax courts make it very clear they don't buy that. So absent some wins in the courts of appeal on this issue, that's not a very fruitful path to go down currently. And certainly you're not going to get anywhere in the tax court with it. Thorough market-based valuations are crucial, relying on actual market data, comparable sales, especially for the underlying value of the land itself. Right? Again, before and after, land without restriction, land with restriction. And remember, they paid very little for land without restriction. Well, comparatively little. So it's really tough to figure out why land with restriction, in essence, somebody's going to pay you, right? You're actually going to have somebody, it's like if it's worth negative, I mean, you're going to pay somebody to take that land afterwards? Don't think that's how it kind of works. Remember these severe consequences of valuation misstatements in conservation easement cases. That there's no reasonable cause defense. Your clients can't say, oh, they got a legal opinion, they got great appraiser, everything's perfect. It says, you are still betting they're right. You can have, as in this case, an appraiser who is a qualified appraiser. You can have a legal opinion that tells you that this is correct. Neither one of those will get out of this penalty unless the court agrees. At least, some court. You got the Court of Appeals now to go to, and maybe you can go to the U.S. Supreme Court if they decide to hear this. But you're going to have to get a court to agree. If all the courts, as far as you're willing to pursue this, or as far as you're allowed to pursue it, remember, the Court of Appeals you can get into automatically. The Supreme Court, not automatic, nor is an en banc review of your appeal by the circuit automatic. So the only thing you're going to get for sure is a 3-judge panel. You're going to have that, at the end of the 3-judge panel in your circuit court of appeals, you're pretty much done, right? We don't know, you have no way of forcing it beyond that point unless the court, either the Court of Appeals decides to go en banc because your case is that important, or the Supreme Court decides to take your case. Let's talk about another collection due process case in offers and compromises. And the tax court, looking at the case of Pally versus Commissioner, Tax Court Memorandum Decision 2025-54, also issued on June the 2nd. Now, this memorandum decision offers some insights into the IRS collection due process framework, particularly concerning offers and compromise based on doubt as to collectability. And it goes into the critical importance of timely communication, providing comprehensive and updated financial information, understanding the IRS procedural guidance, including what's in the Internal Revenue Manual with regard to collection due process. Now, Daniel Pally had an unpaid federal tax liability of $401,279 for 2016. Now, an installment agreement for that liability was granted but terminated on March 15th of 2021. He didn't follow through properly, didn't handle it correctly. On August 16th of 21, the IRS issued Notice LT11 proposing a levy and notifying Mr. Pally of his right to a CDP hearing. He timely filed Form 12-153 requesting a CDP hearing, collection due process, indicating interest in an installment agreement or offer in compromise, noting he could no longer make payments under the prior agreement. On October 5th, he mailed Form 656 offering compromise to the centralized office and compromise, unit. He submitted on grounds as to doubt as to collectability, proposing a payment of $171,348. So he was going to satisfy, he wanted to satisfy his outstanding liability for less than 50%. He said, I can pay you $177,348. He included Form 433A with his OIC submission, which is your collection information statements that detail assets and income. That's what the IRS is going to use to evaluate your offer. Now, the revenue officer's analysis, contacted the petitioner's representative and received additional financial documentation in May, July, and August of 22. That's also par for the course. They want more details to be able to flesh out for sure what they could collect from you, at least in theory, through standard, a little more invasive collection procedures versus what you're offering them. Are they better off taking your offer? And that brings up what's called a reasonable collection potential calculation, or RCP. Using this information, the revenue officer calculated his reasonable collection potential based on future income of $300 a month from the recent wages over 77 months. That totaled $80,184, and net equity and assets of $166,578. That meant that they thought there was a total reasonable collection potential of $246,762. Now remember, the RCP effectively becomes your minimum offer. If your offer is below that level, the service will turn it down. That's the idea when you're talking about, an offer based on doubt as to collectability. Now, the RO concluded, obviously, this calculability to pay exceeded the outstanding liability. $229,895 is what remained after his previous payments he'd made, after the offer payment. So they took the offer payment, which you submit when you make your offer, and you can't get it refunded. They offset that against his liability and said, oh, well, now that's below your collection potential. Now, his representative argued that, certain cash insurance proceeds should be excluded, and recent wage increase was temporary, requesting an average wage calculation. The revenue officer maintained her calculation. So the initial notice of determination sustained the proposed levy and rejected the OIC, concluding he could pay in full and failed to propose acceptable alternative. Now, the IRS conceded there was an error in the revenue officer's analysis. The revenue officer compared the RCP liability, or basically his collection potential after the offer payment had been made, rather than the liability at the time the offer was submitted. In essence, if you did it the way the revenue officer did it, you've already given that up. So unless you're sitting there totally destitute effectively at this point, not quite, but I'm going to say that tongue in cheek, so your client's going to feel they're totally destitute. There's no point submitting it, right? You're there. It also would complicate the average way, a lot of OICs happen, which is a third party who basically could not be made to pay your tax is offering to pay it. A relative, right, is offering to put up $179,000. And the idea there is, no, I mean, if you did this way, they would always take the relative's money and never grant the offer. Because the offer would have basically had to be one that they would have given with a zero offer or a $1 offer, previously. So, no, the IRS concluded, the revenue officer had made a major mistake here. So there was a second appeals officer who assigned the case, determined the correct unpaid balance when the offer was submitted was $230,958.80. Right? The second appeals officer conveyed the petitioner could submit a new OIC with updated financial information as the prior information was outdated. Now, the taxpayer said, wait. You want me to submit a new one now when that money's already been offset? Yeah, it's basically the same thing. So they maintained the original officer should be considered and refused to provide the requested updated information, despite being granted a 60-day extension to do so. Okay, after no new information was received, it was reiterated that the prior determination to reject the offer was correct, as their 246,763 still exceeded the actual liability, and explicitly noted they failed to submit a new OIC. So, at this point, we go to the tax court. The tax court, reviewed appeals termination for an abuse of discretion, as the underlying tax liability was not disputed. It found that they did conduct a thorough review and verified all requirements. The court found delay in processing the offer was not abuse of discretion, considering the IRS paper backlog during the COVID-19 proceedings and subsequent engagement. The court found the revenues officer's actions, requesting updated financials, including cash and business account based on most recent wages, were consistent with the guidelines. Right? What's there? Now, an unpreserved issue was when we got to tax court, they basically said, well, the 77-month period for future wages, that shouldn't have been considered. They said that was not properly raised during the hearing, so the court did not consider it directly. Right? The court reaffirmed that an appeals officer does not abuse discretion by rejecting collection alternatives, sustaining the levy when the taxpayer fails to submit requested financial data. Now, the respondent conceded that there was an error in the liability computation. However, the court found this was a harmless error because the offer amount, 177, was still below his calculated ability to pay, 246. So now we get back to this. Ignore everything else right now. His offer was less than his ability to pay. Therefore, it's not, right? Even when the court recalculated the RSCP using a 12-month period for future income, as they suggested for OICs payable in 5 or fewer payments, the RSCP 179 was still greater than basically the offer amount. It was way closer. I mean, really close. But they said sorry, right? Therefore, any error in the RSCP computation was harmless. The correct amount would still come out more than the offer. So the offer was properly rejected. So, a couple of things. One thing is, you got to be involved. You got to communicate with appeals officers or provide request information. If you fail to do that, that can result in unfavorable terminations, being sustained. You need to update financials. When financial information is outdated, appeals will request updated information received in OIC. Fail to provide the updates, even on remand, can be fatal. Now, again, the tax court is not saying, that they were going to, ignore. In fact, probably the IRS made themselves a little bit worse off, depending on where he got the $177,000 to pay, by coming in and asking it to be redone. But, they still said that, bottom line, even with that there, his ability to pay, basically he was not offering as much as they were computing he could have paid. And that's, that's an issue. If he can pay it, they got to do it. And as the court even said, even back at the beginning, he was way under what he could have paid. So practitioners who are in this area must be very familiar with the IRS's reasonable collection potential calculation method, which is based on guidelines from the Internal Revenue Manual, considering assets and future income. Make sure you raise issues. Remember, it was almost a major misstep that they had not raised how many months of income to consider, basically before they went to tax court. Because as it turns out, it almost was a valid offer if we had reduced that number. That's a, if we had reduced the number of months, it almost would have worked. And that's, that would have been a major misstep and frankly malpractice, because obviously, had we figured that out earlier and recalculated, we just said, okay, we'll pay 180. Right? Going to presume that he could have scrounged somewhere and found that. And then arguably it would have been accepted or could have been accepted, but it got screwed up all the way because we didn't shorten that period. And this is also important by, must be diligent representation, including responding timely, providing comprehensive documentation, actively engaging with appeals, to present the most favorable case for collection alternative. Wasn't really done in this case. There was a lot of things happening, and I realized not all the fault of the representative, but you just got to really understand that. And like I said, there is a very close call from malpractice standpoint in this case. Where had they shown that it would have recalculated properly. And I think there's still exposure because the theory will be, well, you should have figured out the number was going to come in at this other number, not the one you proposed. I've got to assume that what we had here was just not taking into account or not noticing the IRS was going out 77 months, which I suspect is close as it is. In fact, we did pick this up later. There may have been a change. I'm actually thinking that, had we calculated it properly, at least the way the tax court told us was proper, then he might have had a valid offer, but we just didn't. So it's about actually related penalties, navigating negligence and insufficient reliance on a tax professional. Ataya versus Commissioner, Tax Court Random Decision 2025-55. This one came out on June the 4th. Right? U.S. Tax Court is sustaining actually related penalties, providing a compelling case study on the more stringent requirements for taxpayers to demonstrate reasonable cause and good faith, particularly considering lack of record keeping, which this outfit had a problem with, and reliance on tax professionals or tax preparers. Just what they tried to do here. The ultimate responsibility for tax compliance and adequate records rests with the taxpayer. Blind reliance on tax professionals doesn't win. Well, the guy had me do my return. He was going to take care of this. Taxpayers have to understand that if they don't want to engage, they don't want to do things, they don't want to tell you everything, they're never going to be able to rely on your advice. It's not going to stand up for as a penalty defense. They've got to tell you everything. They can't hide things. And some clients like to hide things because they want you to take a position. They become suspicious that if they told you the truth, you wouldn't do it. So they doctor the information they provide you. And if you have not run into that in practice, you will. There'll be a client that hid key facts from you. And you got to tell anybody who does that, you're going to lose. Because, first thing, I'm not lying for you and saying, hey, oh yeah, he told me this, I just didn't know what I was doing. Now, if they do tell you that, what you're doing, then yeah, you have to fall on your sword there. But the flip side of that is that then there very well may be reasonable reliance unless the taxpayer had reason to know that what you told them was wrong. Okay. Now, deficiencies in this case, so we had Hani Ataya and Inam Ataya. This is a mother and son who were 50% shareholders of Cost You Less Cars, Inc., a C corporation, okay? Underpayments were due to unreported qualified dividends. The problem is, there was a problem with money kind of leaking out of the C Corp, let's say. That's where these dividends are going to come from. This allowed gross receipts and deductions from Schedule C. And Ataya's routine of using cashier's checks for purchases, but having no routine for redepositing them or accounting for unused balances, he simply returned them to a drawer for later use. Right? As we'll discover, he was, in essence, in the business of selling used cars. He went to auctions. He had cashier's checks so he could then, pay at auction with a cashier's check. You need, they're not going to just take an IOU from you. They're not going to assume your check won't bounce. So he had these cashier's checks, which is fine. But as noted, he didn't have a method. After he'd gone to the auction, let's say he'd used half of the check. He didn't really have a method for ensuring that that other cash went back in and was accounted for by the C Corp. And as you might guess, yeah, there is going to be accused leakage here, right, of things going out the door to him. In fact, in 2015, $1.5 million was withdrawn from a corporate account for the family home. In 2016, funds from one corporate account were moved to another and used for both corporate inventory and home improvements with no good records of what's what. So, yeah. Taxpayers were unable to find Cost You Less's business accounting records held by their deceased bookkeeper, right? Or another bookkeeper. Amazingly, okay, deceased bookkeeper, maybe I can accept, but the next one? Yeah, is it you can't find them or you don't want to find them? It's kind of how it goes. Now, Stephen Packey, he prepared their corporate individuals' returns, right? They did not review their returns on Mr. Packey's qualifications. All they knew is he was an attorney, right? But they trusted him to prepare and file them correctly, and they didn't actually look at the returns or review them. That is always an awful admission if you're going to try to say you relied on a professional. You're not allowed to just do blind reliance. You have to show you asked for guidance, you received guidance, and we may determine that, based on your education, your background, your sophistication, that it was reasonable for you to rely on that guidance. But just throwing stuff at the preparer and saying, prepare me a return, is never going to work. You have to go way far. Now, on audit, the IRS used a bank deposits analysis method to reconstruct income, right? Because lack of records. Okay. For individuals, for penalties, the IRS bears the burden of production for penalties, requiring sufficient evidence the penalty imposition was appropriate, including there was timely written approval from the immediate supervisor. Now, that timely approval varies by circuit, which is a little bit weird right now, but it's the way it works. The timely approval must occur before penalties assessment and while the supervisor has discretionary authority to approve, before notice of deficiency is issued in the Ninth Circuit, which is this case, right? And in this case, that was all met. It was proposed and approved on the same day, well before the notice of deficiency was issued. Right? So under 66.2A and B1, there's a 20% penalty of underpayments attributable to negligence or disregard of rules or regulations. And they've already conceded, when they got to this point, they'd conceded that underpaid the tax. They were fighting the penalty. So let's talk about their burden of proof for penalties. First thing is, let's talk about the legal framework under this. In reasonable cause and good faith exception, no penalties imposed if underpayments under 6664C1. If the underpayment is attributable to a taxpayer's reasonable cause and good faith, actions to comply. Now, please remember, it is the taxpayer's reasonable cause. I see a lot of tax pros getting confused here and indicating, they made a mistake. Yeah, we get to the Boyd case and why the mere fact that you somehow internally fouled up and didn't file that extension for the taxpayer that they meant for you to file, that's never going to prove to be reasonable cause. Right? Basically, we get to Boyd, and the fact is, well, did they really need legal advice to know that they should file, let's say, an individual income tax return by April 15th or file an extension by that date? It's like, no, that's pretty widespread knowledge. It's difficult to believe that they could not have determined that anyway, but getting professional advice. So that loses, right? So be aware of that. You always have to concentrate on the taxpayer's reasonable causes and their good faith actions. We consider the taxpayer's education, experience, and sophistication, as well as their efforts to assess proper tax liability. So two halves there. We look at their background. If your client is a tax attorney, right, with years of litigating experience in the tax court that it doesn't want to be bothered doing the return, well, they're going to be held to a way higher standard than a client, who has, let's say, high school level education, not really the best at math, certainly has no legal training, not very sophisticated in that area. That person is going to be given a whole lot more leeway than the tax attorney is going to be given. Just saying that's how it works, even if the other facts were all the same. Now, specifically so, for your efforts to assess proper tax liability, reliance on a tax professional can serve as a good faith defense. right? If there are three factors must be shown. Number one, you must show that you have a competent advisor with sufficient expertise. Now, again, based on the taxpayer's experience, education, and sophistication, their ability to find out if somebody really is is competent is judged in that light. Generally, it's not considered, finding a competent professional if they're opinion shopping. If they go to 16, the way you find a competent advisor is not to find the one that gives you the answer you want. That doesn't prove that the 16th advisor after 15 turned you down is competent. In fact, it's a pretty good signal they're probably not the competent one. But same difference, right? As we go here. Opinion shopping is bad. Everybody's considered to know that, right? You need a competent professional, and you also have to consider the professional's potential conflicts of interest or bias. That's why generally you cannot rely upon advice of a professional that was paid for by a promoter of a tax shelter, right? Or is the promoter. Because they're considered to have, you're only going to get paid if you invest in this thing. That is a conflict of interest. And we don't care whether or not they claim that conflict didn't influence them. That's not how this works. The tax court's very simple. That is a conflict, period. We're not going to go through and try to mind read you, bottom line. And you as the taxpayer, you can't mind read either. So you as the taxpayer, you should know that that's a sign that you can't necessarily rely on this. So you need a competent professional who does not have a conflict, because that's one of the things you need to be the competent professional. Bottom line. Okay. The taxpayer provided necessary and accurate information to the advisor. This is key. The advisor, as a competent advisor, should ask you for relevant information. You can't edit it. And even if you're not asked for something, if you know it's relevant, you should have known it was relevant, and you don't provide it, that will kill your, reliance on a pro as well. And if I have to show you actually relied in good faith on the advisor's judgment. That's the other problem with opinion shopping. You weren't looking to be educated about the proper tax advice. You were looking to find somebody who would say you could do this. So you weren't really relying in good faith. You were simply saying, unless you give me the answer I want, I'm not going to pay you. So that would all be bad faith. Okay. Now, the court did not find persuasive their arguments regarding corporate suspension or lost records. By the way, one of the reasons they had a problem was in California, which is where this case came from. If you get behind in paying the franchise tax board, they basically terminate your corporate status at the state level. And that creates a problem because by the way, as the tax court's ruled multiple times, a corporation that under state law has no standings to sue is not going to be able to challenge its notice of deficiency in the tax court because there's no party able to sue. Yeah, if you're in California, if you got IRS and FTB problems, try to get those FTB problems resolved, at least in time to reinstate your corporate status so you can file your tax court petition. Yeah, that's kind of bad. The court found as well that just their basic record keeping for the car dealership was a pattern of negligence, right? His drawer system for unused cashier's checks, without additional control to substantiate their use of return, fell way short of the requirements to keep sufficient records under IRC Section 6001. And the court also emphasized that these weren't people that had never been around car dealerships or those things. He had 20 years in car sales, right? Essentially. He had a degree. I should say his mother had a degree, and she had a background with the state of California handling payroll tax processing. These are people that had a level of sophistication that should have taught them that just throwing these things in desk drawers, that wasn't really going to work. They should have been exposed to methods of record keeping that were consistent with ordinary business care and prudence. I'm not buying your theory that I'm just a poor dumb guy, I don't know what I'm doing. 20 years in the business. You ever seen the dealerships you work with do something like this? Right? Your mother has a degree, right? She's involved in record keeping as well. And she worked for the state in a payroll tax division where you're doing payroll tax work's being done. Yeah, she should have had a clue what adequate records look like. So we're going to decide that maybe the sloppiness is, I don't want to say it's intentional, but it certainly helps if you're going to kind of worry about funds not going where they should. Reliance on professional defense failed. The court found two big problems there. They lacked evidence of professional qualifications of the bookkeeper or the competence of the tax preparer. What evidence was there that they were actually skilled in this area? The mere fact he's an attorney is not necessarily going to be compelling, unless the taxpayers really are very unsophisticated and wouldn't understand why every attorney is not an expert on tax issues, and that background. And as well, they also failed to prove they provided all the information, necessary informations and documents to their professionals. Mere statements that they claim to have done so do not show they actually relied. What's usually bad in cases like this is they don't have. Now, I realize one bookkeeper had died, so obviously that bookkeeper couldn't testify. But not bringing in evidence from the other two to testify about what they got and how they worked, that's something that usually is not going to go well. You really need the pros to come in and testify that they asked you for this stuff, they got this stuff. They had no reason. They believed, maybe erroneously, that was all they needed to know. Right? So essentially, the petitioners failed to present persuasive evidence demonstrating a reasonable effort to assess their proper tax liabilities for reasonable cause, right, for their underpayments. Penalties were basically sustained. Key takeaway on the penalties: documentation is crucial. You must maintain robust and verifiable records. Informal systems like a drawer system for cashier's checks, that's probably about as bad as it gets. Without any proper sort of controls, you could theoretically have another ledger running that control was in the drawer to make sure it eventually got returned. It's not going to suffice. The loss of records is going to disadvantage the taxpayer regardless. Because there's always going to be the suspicion that maybe the records are lost because given how sloppy everything else is, they're better off we don't see them. And it gets really tough to buy this loss of records theory when you end up with, kind of three separate places that somehow just didn't get your records, that don't have records to get back to you. That also gets a little iffy as to how you did that. They will consider a level of sophistication for reasonable cause. Their background, education, business experience, professional background. Business experience are going to be held to a higher standard. If you've been active, especially been active in that business for 20 years, and the other party involved in this, in the identical suit that was moving forward, identical case moving forward, she had been involved in payroll tax, enforcement with the state of California. That's, you're going to be held to a higher standard than, like I said, the high school dropout. That's just simply what's going to happen. To do professional reliance, you got to go way beyond stating, I relied on my tax preparer. Remember, to do this, you've got to show the professionals actually was competent and expertise as you understood it. Right? If you are less sophisticated, you don't need to show as many things. If you're more sophisticated, like, in this case, somebody who had worked on the other side of payroll tax issues, you can probably spot if a bookkeeper or a preparer is probably not paying attention very much, and not really, it's just whatever number you give, hey, that's great. We're fine. All necessary and accurate information must be provided. You got to be able to prove that, not simply state it. Keep records of what you provide the pro. Really important. Generally, I would strongly suggest that they be told, really, what you should do is, make a copy of everything you provide to the professional, and keep that in place, that was provided. You might want to mention even the transmittal letter to the professional that you're sending your stuff in with. Here's the stuff I'm giving you, right? And for some specific issue about tax reporting, probably a statement that, specifically asks for the guidance, gets guidance from the professional, and, that shows that you asked specifically for them to consider this issue. They considered the issue, and you then relied upon their advice. Because that's generally got to be in good faith. Blind reliance without review. Just saying, I paid a CPA to do it. I paid an EA to do it. I paid an attorney to do it. Not going to work. Your clients don't want to believe that, but they have got to participate if they're ever going to get, reasonable cause for relying on your advice. Relying on your advice is not just simply dropping off a shoebox at the office. Not quite the same. And on the IRS side, you still have to watch out for and make sure their documentation supervisor approval met the time frame, but realize it will be different in different places. As I said, here in the Ninth Circuit, right up until the notice of deficiency, you could still get the approval. Other circuits require it earlier in the process. So, be aware that you're there for the circuit. And again, while professional assistance is very helpful and useful, ultimately, tax compliance responsibility and maintenance of records is the taxpayer's problem. You can't get out from under, not reviewing your return. You can't get out from under not having good records by saying, well, the preparer should have told me that, I didn't have good records. Maybe they should have. It's not going to get you out of the federal tax responsibility, right? And also, it's really important to have client education regarding record-keeping best practices. Look, a lot of cases in the tax court, I see them all the time. Every one that comes out, I get a look at. And, in wild number of cases, the problem ultimately is not adequate records. You really should educate your clients about the need for good, solid records. Yes, some of them will ignore you. Some of them will never make it work. They just refuse. They can't be bothered. Well, then, don't be bothered when you're paying penalties, because that's the cost of not keeping adequate records, right? This is. And notice that, and if you're going to rely on me, if you're going to say you're relying on me, you need to document what research you did on my background and my competence. You got to document the materials you provided me and that you specifically asked me for advice on the issue in question. And finally, that you received that advice and that was what you used to take the position on the return. It's not just, I gave it to my tax preparer and they gave me a return. That's not going to work. Now we go to a Federal Register document, 2025-0976, issued on May 30th. The U.S. Treasury Department is asking for information on modernizing payments. That is, no more paper checks. You remember the executive order we discussed earlier. Well, this is now they're going to ask for some comments. You've got till the end of this month to make it, right? It's a significant request for information seeking public input on modernizing federal payments, including tax refunds, to a fully digitized landscape. The initiative represents this major shift. We are going away. Clients will have to understand that they cannot just write paper checks. I don't want to, give them my bank information. I don't want to get anything but a check from the IRS. Not going to work. I don't want to drive the speed limit. I want to be able to drive, 120 miles an hour on Interstate 10 between Phoenix and Tucson. That's great. You don't want to file it. That's still not going to solve your problem when you get hit with criminal speeding. Right? I don't want us, not a defense. Got to remind clients, I don't want to. How are they going to make me? They got the Army, Navy, Air Force. They got ways they could make you. But we'll just phrase it that way. Okay. Now, what's the authority and rationale for this modernization? It comes from the president. Executive Order 14247, Modernizing Payments to and from America's Bank Account was the title of it. It came out on March 25th. We discussed this before. This is an order. Your clients have to understand this is an executive order from the president. Now, if you're going to argue he's exceeding his authority, that's great. You get to take the case to court to argue it. Right? I'm not going to be sacrificed on your theory. Well, I should take, no, you take the case. You want to do that? Great. Hire an attorney, go to court, fine, challenge it. But as it stands right now, I'm going to have to assume it's valid. This order mandates a transition to electronic payments for all federal disbursements and receipts, including any tax refunds, by digitizing payments to the extent permissible by law. And it is to be effective to cease issuing paper checks for all federal disbursements by September 30, 2025. It's a little less clear on how they will handle, payments received, if that's the same deadline. Yeah, I mean, the actual order was just not totally clear on that point. We discussed that a while back. And whether or not, and the other thing, which I think we probably will see in taxes, but again, I tell clients, I think they'll do this, but I can't rely on it. Are they going to make an exception for the 25 tax year, at least for estimated tax payment purposes, and potentially the 24 tax year for refunds. Because otherwise, like the last 2 weeks of the extension season, we'd have to start providing electronic information for direct deposit or something similar. That's, yeah. I don't think they'd do it that way. So I'm thinking we'll probably get some minor relief there, but no guarantee. So I told every client, no guarantee. You might have to make that fourth estimate. You conceivably might have to make the third. I think we're close up to the second now. I'm not going to say it's likely they're going to do it for the second. But in theory, any of the estimates for 25 might be required to be done electronically. Just keep that in mind. We don't know what they're going to do. Now, the primary goals of modernization is defend against fraud and improper payments. We discussed that previously. There are, 16 times more likely for Treasury checks to be reported lost and stolen rather than electronic payments. It may be returned undeliverable or altered compared to electronic funds transferred. Check fraud doubled in 22, the last year they had information for. So they're going to say, hey, we need to get out of this. More and more check washing, interception of checks through the Postal Service. It's happening way more often. So be aware of that. It's going to increase efficiency and reduce costs. That's part of this deal, right? Reliance on paper payments incurs unnecessary cost delays and inefficiencies. They're saying essentially $657 million fiscal year 24 for having to take their paper records and get it into the system digitally. They're looking at saving $657 million per year by going down this path, and it will enhance the security of federal payments. Digital payments are less susceptible to mail theft and other security vulnerabilities of paper checks. You can't really easily check wash an electronic payment. And assuming that, valid encryption systems and authentication systems are in place. By the way, please remember, we need both authentication and encryption. Just one without the other is not adequate. Authentication and encryption. It does you no good to send an encrypted, information for payments, to a third party, over the internet that you think is going to the IRS when it's not. Authentication is how you make sure that's the IRS on the other end. And encryption is how you make sure that somebody eavesdropping on the connection can't, pick up the numbers. So you need both authentication and encryption. I see lots of people, and by the way, privacy is a whole separate issue. Right? I see people all the time confuse privacy, authentication, and encryption. And dangerously assume one of those means I don't worry about, as long as I know I have one of them, I don't worry about the other two. Yeah, that's not how it goes. It's just you have to do that. So, don't confuse these things, right? It really is important not to confuse them. Okay. Now, they are ordered to do a public awareness campaign. So one of the things Treasury is looking for is how the heck do we do this? How do we develop a comprehensive public awareness campaign to inform everybody who gets federal payments or makes payments to the federal government about this transition? And especially how do we deal with unbanked and underbanked populations? People who may not have simple access to a bank account. How do we deal with that? Right? This request for, basically the comments request for information serves as Treasury's mechanism for inviting public input, public comment to inform these implementation effects. Right? And what they're asking for is for paper check usage for government collections and disbursements, they need to understand what factors influencing continued paper check use. Why are people continuing to use paper checks to receive or make federal payments? I think those of us in the tax arena can give them lots of reasons. We know what we hear all the time. Those clients who don't want to use those and who insist on, making, only making payments by check and only receiving refunds by check. Now, I know some of you may very well take the position that because of the high chance that's going to go south some way, that you simply tell people that that's fine, you want to do that, but I'm not going to take on the hassle. You need to find somebody else to do your return. You come with me, you do it this way. Right? That's there, which is fine. You don't have to go that route. Some people do. What are the barriers to transitioning? Right? Individuals and organizations to those EFT options. What are specific challenges for unbanked and underserved? Yeah, kind of obvious. If you don't have a bank account, getting paying your estimates electronically via the IRS, and turning around and receiving payments from the IRS electronically. System's not really set up for that. They have no good way to get that to you electronically. And I'm not sure there's a good answer to that one. I mean, I think I know the answer they're going to use, but I'm going to say, to me, that seems to introduce all the same problems as the paper check. But we'll have to see. What are instances where the agencies themselves don't currently provide electronic options, right? Or where information is not readily available about those options? When do those agencies have to step in and start offering the options? Or when we just don't have the information, they don't make it easily available. What are alternatives to EFT payments for limited cases where electronic methods are not feasible? And they're going to have to solve that. That's the toughest problem to solve. How do we do that? And I am afraid they're going to go back to mailing debit cards, which is, yeah, maybe it's a little bit more secure than mailing checks. But then I think I'm going to have the misfires where people can't authorize them, can't figure out how to make them work, all those things. So, yeah, we'll see. And let's analyze some successful campaigns, private sectors or others, that transition individuals from paper checks to EFT and recommend those strategies for Treasury. Okay. What about the public awareness campaign and stakeholder? You realize we as preparers are stakeholders outreach. What should be the design and execution of this awareness campaign, including what's the content and necessary support tools for the awareness campaign? What are the most effective communication channels for agencies to reach program recipients and other payees? Suggestion for external entities or organizations, private nonprofit, federal agencies should partner with to increase awareness. Don't be surprised if tax preparers become part of this partnering process, right? To get the word out to your clients. Recommendations on federal agencies should inform the public about different EFT payment options. So how do we get awareness out there? What's our preferred EFT methods, right? What specific methods work? What electronic payment methods typically are used by the general public outside of with the government? What are generally used by unbanked individuals if they have to make electronic payment? And what about those who currently rely on paper checks for payments? What methods do they use if they hit a situation where they can't make electronic payment? They can't make a check payment. So to some extent, it's like, these days you understand the last thing you want to see if you're in line at a grocery store is the person in front of you get out a checkbook. By the way, it was never a fast process, but yeah, it's like these days, nobody else is using the cards. Those people have been effectively shamed to a large extent into going ahead and using a debit card as opposed to writing the check. Because I guarantee you, they begin to feel the pressure from people behind them grumbling and doing those other things, like it or not. Okay. Which EFT options should the federal government offer for incoming and outgoing payments? And this is important because when they suggest things, that tells you the things they've already decided they're likely to use. Direct deposit, kind of obvious, right? We're going to do direct deposit. A debit or credit card receiving the payments. My backup is I don't think the unbanked population is probably going to have one. And if you just send them one, that sets up a whole nother set of mess and sets up a whole bunch of scammers to try other things. I'm really concerned about that option, but I'm going to bet they're going to use it. Okay. Prepaid card accounts like Direct Express, same problem, right? With that background, right? In that whole issues as we look at this. Digital wallets, pay it to crypto. Well, okay, but yeah. Which doesn't really bother me, except I would warn a client about, you got to be sure that you're being paid in a format where the value of what you're getting isn't going to change wildly, over the time it takes them to transmit it. And if you're in certain volatile cryptos, obviously that's easy. Yes, a stable coin might work, but then we also have to be sure that the stable coin actually stays the stable coin. And remember, we had a couple of years ago, some very, very public, basically crash and burn stable coins that didn't stay stable, that couldn't maintain the $1. And that was a problem. So you have to see that in that case, right? And real-time payment systems. Is there some way they could partner with, a 7-Eleven, a bank, whatever, with a way that could verify the identity? Now, how well that works is open. Your 7-Eleven probably doesn't have the cash to do it, right? And does your bank really, how much would the federal government have to pay a bank to be willing to, take on that responsibility, which I think is going to be a lot, because I don't think a bank would ever want to do it. That's a whole different problem. That's EFT options for those who are not banked is going to be probably one of the most difficult things, or those who don't want to use direct deposit. There's where I think the problems are huge, and how they're going to address them is going to be open. What are potential risk consideration related to offering those methods? Yeah, I mean, I think sending out cards in the mail, I just see fraudsters getting ready to try to take advantage of that. Take the fraudsters about 2 minutes after you do something to figure out how to scam people, and they don't necessarily even have to mail you anything. They can just do it with text. Hey, we've got your tax refund. Please log into this site, and we will then send you your debit card. See it already. Come on. How many people here have gotten the text about their tolls and weren't paid? Which is hilarious here in Arizona, because we have toll roads. So if there's a part of transportation coming after me for an unpaid toll, it's like, okay, the first question, where exactly is any toll road? Okay, well, that's kind of the issue that they've got. Identify administrative, regulatory, or statutory barriers to offering certain types of EFT methods. The strategies for the government to prevent fraud and ensure secure payments when using those options. Yes, the whole point of this is to reduce fraud. They're going to have real fun executing this. Because again, I think the fraudsters will be more creative. Right now, yes, grabbing the checks coming in the mail is the easy, low-hanging fruit. But especially when you force everybody on, so you have less sophisticated people, because most people that do electronic payments now, are probably a little more sophisticated in terms of being aware of what to look for, what to look out for. Not that they all are, but when you just force everybody that way, I think you're going to have a problem. But that's my own case. And suggestions for organizations or partnerships that can provide EFT payment access for individuals or businesses without bank account. That last one is probably going to be the most fruitful way to go. But again, what business or what organization is going to want to take on having to authenticate? Because presumably, if you release that payment to somebody who is not the person who received it, well, probably end up being liable. Right? And they also ask open-ended for general comments, right? For any other issues or considerations related to the implementation of this order, right? The audience, the tax professionals, their firms, related industry organizations are strongly encouraged to provide their insights to Treasury. And all comments submitted are considered public, so will be posted online. So don't put anything up there you don't want everybody to know. Okay, that's it. Don't put confidential or inappropriate for public disclosure. Don't disclose stuff. Probably not good to go into great detail about this client that you think's an idiot who, won't allow electronic payments and how, they've been doing. I mean, eventually you've ended up disclosing enough about that person that it could be figured out. Certainly if they ever see it, they'll figure it out. Yeah, it's like, don't do that. You can talk generically, but yeah, don't do that. How do you submit it? Well, you go to regulations, www.regulations.gov, or there's a direct link that I've also got on the slides right there and in the materials. And some commenters have the option to attach their comments as a file and or attach supporting documents. So you could write it up, as a letter in Word. You don't just type it in online. And then attach that Word document, make it a PDF and attach it. That'll go. The deadline is the end of this month, June 30th. Okay. And the collective impact from tax professionals can help, basically shape this system. Explain the problems, explain the issue, explain the pushbacks. And hopefully we'll get something that works. I think we are in a unique position to see specifically what's likely going to be real pain points. And ones that the parties pushing this may not have realized exist. It's very easy when you don't normally deal with that population, right? Either the unbanked or the, I don't want to give it to them, right? The paranoid, shall we say, who aren't tech savvy, Because, by the way, as I tell anybody who complains, I don't want to give the bank my bank the IRS my bank account number. You're going to give them a check? Yeah, I don't want to give my bank account number. It's like, you please look at the bottom of your check. Yeah, bank account number is right there. Everything you're going to be asked to give them is right there on the check. So if you're sending them a check, don't tell me you don't want to give the IRS your bank account number. You've been giving it to them for decades. Yeah, that sometimes doesn't go over well, but we'll take a look at it. Next up is the Kelly case. This is the Ninth Circuit case number 2370040 that came down this week from the Ninth Circuit Court of Appeals. It looks at the issues of if a debt is worthless, right? Is a debt automatically worthless if it is owed to an entity that has had that debt discharged? And what you're going to discover is the Ninth Circuit is going to say, no, it's not automatic. It depends on how the discharge happened, and a number of other factors are going to get in here, of course, none of which Mr. Kelly showed. Now, it's an interesting case. If you go back and actually get the tax court opinion, it goes off on a whole bunch of other topics all over the place. This is a case where Mr. Kelly decided not to appeal a lot of the details the tax court decided. He did this specific issue really was his one big issue. The Ninth Circuit gave clarification on the distinct legal standards for claiming a non-business bad debt deduction under Section 166 of the Code and recognizing cancellation of debt income, again, under 61A11 and 108. And the opinion unanimously rejects the notion that a debt's discharge on one taxpayer, even as a valid discharge, automatically renders it wholly worthless for deduction purposes. You still have to show objective proof of worthlessness. And as you're going to discover here, it's especially going to be a problem in this case. Now, Michael Kelly, he was transferring millions of dollars among his businesses. Kelly Capital, First Commercial Corporation, Greenback Enterprises, between 2007 and 2010. He characterized all of these as loans among these entities, right? On December 31st of 2010, Kelly canceled many of these loans, right? Now, Kelly reported $145 million of cancellation debt income, which he excluded from his personal return due to his claimed insolvency. Some of these loans went to Mr. Kelly. He said, hey, I don't have cancellation of debt income, right? But, I can't pay it back because I'm insolvent even after this discharge. So I don't have to pick that up under 108. FCC and Greenback also reported COD income and excluded theirs also due to the claim they were insolvent. But the bottom line was some of these loans went from Mr. Kelly to these other entities. And he reported a short-term capital loss of nearly $87 million due to a non-business bad debt write-off, including $17.8 million owed by FCC and $2 million owed by Greenback to Kelly Capital. Really getting through these cancellation of indebtedness now. So, remember, we have these related entities. And he claims that all these loans were canceled. Nobody can pay anybody anything. So, obviously, there were two questions the tax court was going to look at. First thing was really cancellation of indebtedness. But secondly, even to the extent that the tax court concluded that, in fact, these entities, they were legit debts and they were canceled, by Mr. Kelly, he basically said, you don't owe it to me anymore. Does not mean automatically that he gets to pick that up as cancellation of indebtedness deduction, or a deduction, which for this case is a non-business bad debt, because he was not in the business of loaning money. It was an investment style bad debt. And so it's a personal bad debt, and short-term capital loss is the treatment of that. Now, he contended the canceled debt, even one to the related parties, even where you loan money to a related party, and then said, okay, I'm not going to collect anymore. I'm not going to go after you for collections. We're done, right? That automatically became wholly worthless upon discharge, right? Thereby generating both COD income for the debtor, who remember was insolvent, therefore excluded under 108, but also for Mr. Kelly, who was the debtor in this case, right? Or I should say, he was basically the creditor in this case. Get the right name there. At least for these loans, he was a creditor, right? So said those two have to happen simultaneously. Definitely the case law refers to, the same sort of standards in some ways to prove that your debt is canceled and to prove that you have, a bad debt. They're not totally identical. Now, the IRS disagreed and disallowed the deduction. The tax court ruled, and like I said, the tax court ruled on a lot of things, but this is the one issue he took to the Ninth Circuit. He failed to establish that debts were owed to him by FCC and Greenback were wholly worthless. To the extent it was found they were debts, he failed to show they were wholly worthless. Now, again, we're ignoring the other side of the transaction. We're saying the other side of the transaction is irrelevant. They could say that, yes, for FCC and Greenback, those were that COD income. Now, separate question whether those two were insolvent at that time, but, their creditor's not going to collect anymore, not going to try to collect. So, bingo. They have no intention of repaying. The creditor doesn't intend to take action to collect. Yeah, that's the test for COD. Now, to claim a non-business bad debt deduction under Section 166 of the Internal Revenue Code, you got to establish three elements. First, and this is often a problem we have with these, is the debt bona fide? The problem with bona fide debt quite often is too often these loans, these short-term losses from loaning, a lot of times people are trying to claim them for loans made to relatives or kids or those sorts of things. And it quickly becomes a discussion as to whether that was truly an arm's length loan. Was there any realistic expectation of repayment? Were the terms realistic? Would a third-party creditor have even considered making this loan on these terms? That's what you got to watch for bona fide, right? And it does depend. If your kid has no realistic chance of repaying the loan, and you know that because nobody's going to loan to them, you're going to have trouble showing the loan's bona fide. Not necessarily impossible, but rather difficult. The taxpayer had to have an adjusted basis in the debt sufficient to claim the deduction. Again, records are key there. And again, a lot of times they do have the record on this. I haven't found that to be as big a problem. And finally, the debt became wholly worthless in a taxable year under 166A1 and under the regulations, Treasury Regulation 1.665A2. The burden of proof for worthlessness rests squarely on the taxpayer. So that's it. So, bona fide, we have basis, but then we got to establish which year it became worthless. And it's got to be wholly worthless. And that wholly worthless is going to be a big problem for us, right? Because if there's any value whatsoever, any possibility of collection, any of it at that point, right, then we have a problem. Now, this worthlessness requires establishment of sufficient objective facts as, a mere belief it is worthless is insufficient. And the standard is 0. As you'll discover, invariably, he got on the stand and essentially, did say, well, not totally, but virtually worthless. And that admission is enough. Just kill it right there. I don't care if you loaned them $17 million. And at best today, that debt, you could sell it to a third party for $1.50. You still can't claim the write-off. Got to be 0. Okay. So, yeah, his admission didn't help. He did do that too, which is not a good thing in this case. Any value will make it not wholly worthless. Got to wait till it's wholly worthless. Now, worthless can be proven if any legal action to collect the debt would be entirely unsuccessful, considering all your rights. Okay. The Ninth Circuit rejected Kelly's assertion that it was worthless, and that worthlessness in 166 and discharge in 61A11 are synonyms. If one applies, the other applies. Worthless is defined as essentially lacking value or utility. Discharge is defined as a release from the payment obligation. The court concluded that while a debt might lack value at the time of discharge, does not as a matter of law eliminate the debt's prior objective value and render it worthless. So here's the catch. Kelly can't just by saying, I'm not going to go after you for it. he can't therefore argue that the debt is worthless. If you made it worthless by eliminating your legal right intentionally with full knowledge that that's what you're doing, no, that doesn't prove worthlessness. They said, let's be honest, the system could be gamed wildly if that was it, right? They're saying, no, we're not going to allow you to do that. Sorry, Mr. Kelly, that doesn't work. The court emphasized without an objective test for worthlessness, any monetary transfer could be classified as a loan and later canceled to produce an illegitimate tax benefit to the claimed creditor, particularly for a non-arm's length translation. Right? We throw this in there. We loan it to an entity that really, questionable, or maybe they could repay. We just say, we're not going to collect it. Now, they're saying we're not buying that one. Sorry. COD income is based on the freeing of assets theory, right? COD income under 61 and 108A1B operates under the freeing of assets theory, where discharged debt generates a potential gain depending upon the taxpayer's solvency. The theory, the court stressed, has no relation to the worthlessness. It's not a reciprocal effect on the creditor, right? It's, does this discharge actually free up any assets? If it does, then the COD is taxable because there are assets that now you could get to keep, in theory, if you liquidate to pay off all your debts that previously you couldn't. If you tried to liquidate to pay off all your debts, this one was there until it got discharged. And so if you're still insolvent after the discharge, we didn't free up any assets. So that's the key. The court analogized Kelly's claim to an insurance payout for intentionally burning one's own house, highlighting the absurdity about how that would work, that could become a bad debt. Oh, well, I burned down my own house. The insurance company is not going to pay me. Oh, that's a bad debt, right? They owed me the money, but it's a bad debt. It's like, no, you caused the situation that caused you not to get paid. So the insurance company starts with, oh yeah, your house burned down. We're going to have to pay the claim. We're going to have a claim here. When they discover you did it yourself, yeah, that was, you basically killed your own ability to take it. So they're saying, no, we're not going to go there. So the key facts here, no worthlessness was proven. As I said, Kelly himself conceded the debts were not wholly worthless, described them as nearly wholly worthless, which means, yeah, Mr. Kelly, that was a really bad admission. Okay. Good news, you were truthful. Bad news, truth will not here solve your problem. Right? The evidence presented to the tax court supported this concession, demonstrating that FCC and Greenlee possessed assets during the tax year, including at least some portion of the debt was recoverable. So the catch was he could have gotten part of it back. He just decided not to. His subjective determination was it was not relevant. Now, yes, bottom line, you're not required to be. You can decide I'm not going after it because why should I spend, $500,000 in legal fees to collect $50,000? It makes sense. That's not really how this one worked. Now, it affirmed the tax court's decision. It did not err by requiring Kelly to prove worthlessness of those discharged debts, by declining to assume worthlessness just because Kelly said, hey, I'm discharging it. And that's not automatically worthless. Right? The standards for recognized COD income and claiming bad debt deductions are distinct and governed by separate statutory requirements. Practitioners must ensure objective proof of worthlessness, especially in related party transactions. The fact you discharged a debt to a related party does not prove it was. In fact, that generally is where you get into trouble because your client decides, okay, I'm not going to collect from my kid, right? I'm not going to collect. I know I loaned him $50,000, $100,000, to buy his home. So, and nobody ever said in on any of the stuff we submitted to the bank that this was a loan. It also is a bad fact. I'm just not going to have him pay it, right? And no, if I had him pay it, he put him he'd be in tight financial situations. I don't want to do that. So, I'm going to go ahead. Yeah, that's great. Nice. But the fact you canceled that debt is the only reason why you can't go after him. And you likely just made a gift. If you didn't make a gift when you first made the loan because you had no intention of collecting, you probably have just made a gift now. Okay. And finally, we have a U.S. Supreme Court decision this week that looks at a religious exemption landscape under FUTA. Well, actually, under state unemployment tax in this case, but there is a similar FUTA provision. This is unemployment compensation tax. And this is Catholic Charities Bureau, Inc. versus Wisconsin Labor and Industry Review Commission. U.S. Supreme Court case number 24154, issued on June the 5th, 2025. So in this case, Supreme Court decision offers insights, advising religious organizations on unemployment compensation tax exemption. This could be triggered in more states than just Wisconsin, right? It highlights the interplay between the First Amendment principles and state law taxes. The key takeaway is that a state law exemption for religious organizations must adhere to strict First Amendment neutrality requirements, particularly avoiding denominational preferences based on theological distinctions, like whether they proselytize, right? Out there, are they trying to recruit people for their church? We're going to find out in this case the fact that they weren't doing that in some of their activities, the ones in question, was why the state of Wisconsin said you owe unemployment taxes. Now, Wisconsin has an exemption which is based on very similar federal law, that you don't have to pay unemployment compensation taxes from nonprofit organizations that are both operated primarily for religious purposes and operated, supervised, controlled, or principally supported by a church or convention or association of churches. There's a federal statute that is very much mirrored in its very similar structure that you'll find under Section 3301 of the Internal Revenue Code. And over 40 states have adopted that language basically word for word, creating the same exemption. Here we're looking at Wisconsin and a particular fact pattern of how they have interpreted it. Okay. Now, Catholic Charities Bureau, Inc., the Bureau, when referred to in the case, and 4 of its subentities serving as the social ministry arm of the Roman Catholic Diocese of Superior, Wisconsin, were involved in this case. Now, their mission operation involves providing services to the poor and disadvantaged as an effective sign of the charity of Christ. They do not distinguish clients, staff, or board members based on race, sex, or religion. You do not have to be Catholic in order to receive these benefits from them, right? And this no proselytization provision is specifically is to adhere to a Catholic doctrine that prohibits misusing works of charity for purposes of proselytizing. In essence, you shouldn't be bribing people, right, to come to the Catholic Church, would be their theory. That in essence, that good works should be good works, unconditional good works, not conditional good works. And that is part of their doctrine, and why none of that goes on in these particular, social service organizations that are benefiting the poor. Okay. Now, the Wisconsin Department of Workforce Development denied the exemption. While it acknowledged that petitioners were supervised and controlled by the Roman Catholic Church, it asserted they were not operated primarily for religious purposes because they didn't go out there and try to get people who they were providing these services for. They didn't require them to be a Catholic, or they didn't require them to sit through, various things. They weren't actively trying to convince people to become Roman Catholic. So presumably, you would say, hey, we are part of Catholic Charities, but they weren't actually doing that. Specific churches were not coming in and saying, you should come to our services next Sunday. They weren't saying that. They weren't doing that. As I said, by doctrine, that was considered to be cheapening or not true good works. It was conditional work, right? We'll help you as long as you help us, was kind of the way it would be interpreted. Now, the Wisconsin Supreme Court said, though, primarily for religious purposes requires an inquiry into both the organization's motivations and its activities. And the key problem here, activities. Did they conduct worship service, religious outreach, ceremony, or religious education? And they found that all activities were secular in nature. They may have been motivated by a doctrine, but the actual activity was secular, right? It didn't meet any religious, didn't do anything religiously. It was going to be very similar as to going to a service center that is not run by the Catholic Church or not run by any church, right? Just going to provide that. And they rejected their arguments that this violated their First Amendment rights. They were being discriminated upon specifically due to the concept that the Supreme Court will latch on to, denominational preference. If you were a church, let's say Church C, whatever Church C is. I won't name a specific denomination because I'm not really into the deep details of how they operate their social ministries. But let's say Church C said, yeah, we're going to do that. We're going to service the poor, etc. We're going to devote funds to that, but we're going to require everybody who comes in and receives that to sit through a religious service, right? Or listen to, a kind of rah-rah religious, you need to come to our church and get all the marketing and all that sort of stuff done, trying to get them signed up. And saying, you got to do that, right? So the argument is that, wait, you're giving an advantage to a church whose doctrine says that's fine. The fact that we have come to the conclusion that that's not fine, that basically offsets entirely the good work you're doing, you're going to punish us for that position. So that was what was before the court. The U.S. Supreme Court, in a unanimous decision. Now, there are two concurring opinions, so it's not like they all agree. They agree in result. Don't necessarily all agree how we get there, or they may agree we get there the way that the majority opinion says that works, but other things would work also. The one thing remember about concurring opinions, they couldn't get a majority of justices to go along with them. So a majority on the court did not agree to add this to the opinion. Therefore, technically, now the majority didn't say it didn't apply. The majority also, though, refused to say it did apply. So you always have to read concurrences with a bit of, it might work this way. Did the other justice simply say we don't need to decide this, or we're not going to? Which the Supreme Court does love to do. You don't decide things you don't need to decide. Or did they literally say, no way, we don't agree with that? And there may be a mix of both among those who did not go along with the concurring opinions. But there are two concurring opinions. Okay. So what did the majority opinion, authored by Justice Sotomayor, say? The First Amendment mandates government neutrality between religions. You've got to be neutral, and what Wisconsin did was not neutral. Denominational preference. The court reiterated that the law differentiating between religions along theological lines is textbook denominational discrimination. Remember, every justice bought this argument. Everybody did accept the argument, that it would. Now, they may argue there's other things, but they did accept that this is textbook, right? Wisconsin interpretation imposed a preference. The eligibility hinged on inherently religious choices being made, such as whether to proselytize or serve only co-religionists. If Church C either does that outreach in there, says you got to sit through the church service, says, that we're going to hold on site, or says, you have to sit through this, this discussion, etc., this counseling, telling you about why you should come to our church before you're allowed to get the benefits, or you have to be a member of our church to get the benefits. They said that is a religious choice, and different religions make different choices on those issues. You're not allowed to favor one choice over the other. Right? A civic organization on grounds related to fundamentally theological choices, whether to express and inculcate religious doctrine as part of your good works, facially favors some denomination over others, and that blown out of the water by the First Amendment. You're not allowed to do that. Strict scrutiny is applied. Because Wisconsin law is applied, granted denominational preferences, it had to be closely fitted to a compelling government interest. And they said it failed to satisfy such strict scrutiny. Now, the state argued that, it had an advantage in ensuring unemployment coverage. The court found the law under-inclusive because it exempted other religious entities providing similar non-proselytizing services if done directly by a church. If a church itself did this, not an organization related to a church, it would be exempt. So let's say instead of having, a service that was offering, meals for the poor via this third-party service, but rather had a specific church was opening up its doors and offering meals to the poor, it would be exempt for the employees working in that. So it's like, no, you can't do this, right? The fact that we don't throw churches in at that point, that blows out of the water any theory that we're doing this just to make sure everybody gets covered, right? And the state interest, avoiding entanglement with employment decisions, this law was over-inclusive by applying to all employees of the organization, not just those tasked with religious inculcation, right? What's saying is your problem there is that you might need to impose this on a minister or somebody of that sort who may have objections to this type of insurance. They're saying, well, no, here's your problem. You're still exempting everybody else at that organization. If that truly would be the motivation, then we'd only exempt those particular problematical people. So it said Wisconsin had basically, sorry guys, you blew it. There has to be neutrality between religion, between different types of religion. It's got to be neutral, and this was not a neutral law. If you proselytize inside the service, inside this other agency that you control, the exemption applies. If you don't, sorry. But it's based on our religious convictions. Sorry. While your motivation is religious, your activities aren't. And the Supreme Court said that's garbage. You're not allowed to go down that path. Now, there are two concurrences here. One is authored by Justice Thomas, right? He emphasized First Amendment's guarantee of church autonomy, which grants religious institutions the right to define their governance structures, right? He argued that they had erred by directing the Catholic charity status as an arm of the diocese as a matter of church law, treating it as a distinct non-religious entity based on the corporate form. And this is kind of indirectly going after what the majority opinion said. If a church did this themselves, there's no problem. But if they decided to form a separate entity and do it through the entity, he said, no, churches should have autonomy to structure themselves as they want without losing tax protections. Justice Jackson's concurrence, which I find it funny that we have people from opposite ends of the spectrum on the Supreme Court who each did their own concurrences. Justice Jackson pointed out that this phrase, imputed parallel statutes, refers to organization's function, what it does, not its motivation, how or why it does it. Right? A function-based reading aligns better with legislative history, the anti-entanglement goal as adjudicating employment for entities that, those who are preparing for religious life is more likely to have entanglement than for general charitable organizations. So, she still gets the same point of saying that, this is still violated, but they're saying it should be a different test. So, you have those. These concurring opinions could become important if we have changes in the court. Different members, new members come on. You might see a later court lean more on one of these justifications. But currently, they all agree the result. Catholic charities in Wisconsin do not pay, will not be paying, basically payroll taxes or basically the unemployment taxes to the state. Now, some key oversights on exemption criteria. Watch out for state exemption statutes that differentiate among religions based on theological choices or practices, right? Again, requiring or barring proselytization. Such criteria are highly susceptible to being strict scrutiny and going out. Again, the more constitutional issue is understanding compelling interest in narrow tailoring, because that has big issues as to when they can go outside of this protection, the First Amendment. Understand that advising hierarchical structured religious organizations, ensuring state definitions do not impermissibly disregard these structures. We talked about that. And also talk about function and motivation, right? Considering whether advocating for an organization based primarily for religious purposes, based on what the organization does, its function rather than its motivations, and activities like proselytizing. So yeah, that's kind of where you go. So this has been the Current Federal Tax Developments for the week of June the 2nd, 2025. Current Federal Tax Developments are brought to you by your state side of CPAs. I'm Ed Zollers. My email address, edzollers@currentfederaltaxdevelopments.com. You have some quick questions, drop them off there. I also keep an eye on the Connect sites for Arizona, New Jersey, Minnesota, Illinois, Idaho, Washington. So if you're a member of those societies and you participate in their Connect sites and post messages there, and I see something I might be able to help with, I may respond. So keep track of that. Coming week, we'll see how things go in this upcoming week where we have it. This is actually the week of June 9th. I didn't change the second slide. So hey, what do you know? That should be June 9th if you look at that slide on the screen. But bottom line, we will see you next week. That'll be the due date for all those things due on June 15th, as it becomes one day later, which means second quarter estimated tax payments due next Monday. Keep that in mind. And we'll see you next week here on Current Federal Tax Developments.